the Compass. We're recording this episode on Tuesday, May 6th. Just as a reference, the new Canadian Prime Minister is meeting with Trump today, so this could throw anything that we say into absolute chaos. But we'll give it a go. With me, as always, is Sam Plez, President, CEO, CIO of Olive Resource Capital. My name is Derek McPherson, and I'm the Executive Chair of Olive Resource Capital. A couple of things news-wise today that we want to cover, but I think talk a little bit about our own news first. So for those of you who don't know, Olive is a publicly listed investment issuer, and so effectively something that investors can invest in. And really on this show, we talk about how we invest and what we're invested in. We recently put out our Q4 financials, year-end financials for year-end 2024, and then also provide an update on our investment, our positions, and how the investments have been doing since the beginning of the year up to the end of April 30th. I have to say, I think we're doing pretty well. But Sam, maybe I'll turn it over to you. You talk a little bit about our performance, then we can talk about some of the specific areas where we think we're winning.
Yeah. So we put up the year-end numbers. Since then, the portfolio has appreciated materially. I actually haven't done the exact count, but over 20%. I think something like 23 or 24% for the first 4 months of the year. That's already net of what we call net of fees, net of all the expenses incurred by the company. So the true number that investors get to participate in. And like I said on the press release, it's a result of stock market appreciation and the investments that we're part of that have performed some of them quite exceptionally this year.
Yeah, I think that's the key. And if you look at our breakdown per se, we're pretty heavily weighted towards precious metals. Now, that's not all gold. We could talk a little bit about that with a couple of names, especially from the beginning of the year, really outperforming. Specifically, Omai doing very, very well. Full disclosure, where I'm a director as well. And it's the largest mining position in our portfolio. And if the stock keeps going up anymore, it'll be the largest position in the portfolio here shortly. It's about 14% of our assets as of April 30th. And then the other one, another name that we own that's done really well is Troilus. Orion has done well. We've got a lot of our gold names. Obviously, a lot of our gold names have done really well. Silver 47 as well on the silver side. So, there's been a pretty solid theme there.
Yeah, so I would say Omai and Troilus are up something close to 100% for the year, 4 months. And those are 2 of our 5 largest investments. So pretty happy with that performance. That's obviously been the largest source of performance for us. We've seen performance across the board, but obviously when you get 2 names that are up something like 100%, obviously they're quite meaningful.
Yeah, I think that, and then I think where we've seen, I guess, sort of positive surprises. I think we've done very well on Sailfish this year. Even with, that's a convert that we have that's converting because it's exceeded the conversion feature in it. The put feature on the conversion is being called, which I think is great. And that stock is up materially, even from the conversion price north of 210. I think market's starting to recognize the potential there. And then even one of our other big copper positions, which hasn't necessarily outperformed this year, is Arizona Sonoran, and it's actually done quite well this year. Now, we viewed it as undervalued, and it was undervalued, and so I think we're getting a bit of a catch-up trade on that as opposed to just on the gold price.
Well, it's actually performed quite well. It's up about 30% for the year. If you look at copper prices, they're somewhat flat, maybe 10% up on the year. So it's a very good performer in that context for the sector that it's in. Obviously, a lot of it has to do with the U.S. administration, the location where the asset sits, the up and coming news releases that we expect from them in terms of the amended PFS or the new PFS. Resource update first and then PFS later. So, lots of catalysts on the horizon for the year.
Yeah. Well, and Hudbay's investment also has obviously made a difference there as well.
Yeah, exactly.
So yeah, I think we're having a good year. Some people might say that 23, 24% that we're up Relative to probably a pure gold fund, we're probably underperforming. But relative to a traditional resource fund, so we have a broad resource mandate. So we invest. We have the basically, if it's mined or grown, we pretty much will invest in it at the right opportunity at the right part of the cycle. And so the consequence of that is that we're broadly invested across different areas. Obviously, with knowing that gold is doing well, there's a focus there, and obviously we have a significant weighting towards precious metals. So off to a good start this year, and hope that continues. It is May 6th, so hopefully it's not sell in May and go away this year. For the resource sector.
I think this is a good opportunity to pick up where we left last week, which was how are we positioned and what do we think happens next. And I think that will feed into some of the news flow that we want to cover on this episode. But we are roughly just over 50% allocated to precious metals. The majority of that is gold, but we do have some small silver exposure and a little bit of PGMs in there. We have two investments that are not resource focused, so that takes away some of our flexibility to deploy any further. But I think the focus for us remains precious metals for the time being. I think absent some major news flow on the macro front from China or the US related to tariffs and some resolution on that, all of the other kind of metals and commodities remain sort of somewhat under pressure.
Yeah, I think that's fair, right? I mean, there's a lot of trade uncertainty, particularly between China and the U.S., two of the world's biggest economies, and a lot of metal. You pick a commodity, a lot of metal flows through China, and so the consequence that makes this uncertainty probably even higher. And so, yeah, I think but that uncertainty. The flip side of that is really good for gold. And so that's where our focus is. We kind of have a couple buckets in our portfolio, if you will. One bucket's we call fundamental investments. So that's things like Omai or Arizona Sonoran, where we're taking a view as much on the company and its ability and its relative valuation, its ability to go up, as we are the commodity. And then the other, and those tend to be more difficult to trade in and out of. And so you tend to be a little more tied to those positions. The second is what we call liquid, and those tend to be a little bit more larger cap names. And so we can get in and out of those positions easily. Technically, we define them as we could trade in and out of a position in a day. And so you're talking about mid to large cap names for us. And I think that those, the weighting on the fundamental portfolio, yeah, we could tweak it on the edges, but it's, where we add and where we're not adding. But where we tend to adjust for the macro environment in the short term or in the medium term is on the liquid side. And obviously we're weighted towards gold there as well right now.
And on that fundamental basket, I think we've expressed before on those episodes, we think the right place to be right now is in projects that have a very high likelihood to be built in this cycle. Whether that's gold or other commodities. In the case of Arizona Sonoran, that'll be copper. But we like projects that are at that advanced stage that are prime candidates for a takeover, or to self-fund with a complete project finance package to build these assets and benefit from the commodity cycle that's already upon us. And if you see the holdings that we report, which are our largest holdings, almost all of them fit that category. So I think that's a good segue into the news flow, which is the increasing M&A activity that we've seen over the last 12 months and that we don't expect will end anytime soon.
Yeah, another Monday, which was yesterday, and another merger. So I guess it actually came out Sunday night, but Goldfields announced that they were acquiring an Aussie company called Gold Road. The two companies are joint ventured on Gold Road's main project, which is called Gruyere. And, kind of a surprise because they've been joint ventured on that project. The project's been purchased 2017, 2018, something like that. And so another acquisition by Goldfields, or they're consolidating a joint venture. But Sam, you kind of ran the numbers on it. So what do you think?
Yeah, so the numbers are a little bit messy because hear this. So Gold Roads has the joint venture, but it also has a lot of paper in De Grey. It was the largest shareholder of De Grey, which was taken over by Northern Star. I don't think that deal has closed yet, hence why those shares haven't been distributed. So you have to factor that in. There's also a royalty on the Gruyere deposit on the portion that's attributable to Goldfields, which naturally will be sterilized in this acquisition, but you have to value it somehow. And there's other side projects that are also folding into the package, not just the joint venture that's being acquired as the entire portfolio. But the numbers are, it's a $2.4 billion acquisition by Goldfields.
That's
US,
Aussie, right?
yeah, US,
US, okay.
at face value. But then once you subtract sort of the value attributable to the Northern Star / the Gray shares, it's about a 1.7, 1.8 billion US acquisition. Still a pretty nice valuation. So what do you get for $1.8 billion? You get 50% of the Gruyere deposit or production. That's a project that produces about 340,000 ounces a year. Has about 6 million ounces in resource. So if you look at just the bare multiple on that, they're paying about $600 an ounce, which is certainly above the normal ranges of what you would expect. Typically, we see something between 5 to 10 or 12% of the gold price. Remember when gold was 2,000, the deal's done at 200, where sort of at the top end. The gold is on at 33,000 or 3,500. 600 seems like above average. But more importantly, even though there's a big resource, this is not it's a pretty nice producer at 340,000 ounces, but that doesn't put it into the year one category at this point. So on this valuation, they're paying about $10,000 per ounce of production per year. So at this price, 3 full years just to recover that value on a revenue basis, not on an income basis. So it does seem a little bit hefty. Like you said, maybe it's justified. This is a producing asset in Western Australia. I've actually had a chance to visit this project back in 2017. It was just about to enter into production, and it is a beautiful project, no question about that. I'm just wondering if there's a way for Goldfields to move this to the 500,000 ounce category, because otherwise it seems a little bit rich from where I sit.
Well, I mean, the other thing is, and we've seen this a couple of times with majors getting involved in large assets in Canada in particular, with Agnico when they bought Detroit and they bought out the 50% interest in Canadian Malartic. As you said, right, that they could have a plan to invest that Gold Road doesn't want, that its joint venture partner doesn't want to participate in, that makes it 500,000 ounces. The other thing is that, it might seem expensive at this moment, but if we're at the start of not the start, but if we're in the early stages of a gold bull run, maybe it's expensive on a $3,000 an ounce outlook, but maybe it's not expensive on a on $4,000 or $5,000 an ounce outlook, and that's the position that Goldfields is taking. So
yeah, probably also the soft angles of they made an investment in Quebec. Now they're making a further investment into the GV in Western Australia. In my mind, the two best gold mining jurisdictions in the world. So yeah, maybe it is justified to pay a premium. And for the record, I looked at Agnico just to put this in perspective. The multiples on Agnico are higher than what Goldfields is paying for, justifiably so. But that is to say, they're paying above market, but they're not paying outside of the envelope of where the best companies sit.
Well, and I think the other thing is that part of that premium that Agnico gets is the location of their assets, right? The majority of their assets are in Canada, period. But there's also, they've also got just look at where Goldfields' assets are. They have Australia, Canada, Chile, Ghana, and Peru, and then South Africa. So maybe they're looking at a focus of upgrading the quality of their portfolio, and that is with an intent to improve the multiple and paying a little bit more for an Aussie asset. Maybe that makes sense to them. I think, I think we'd have to. I think our view would be that the jury's out. We're not shareholders of Goldfields. Unfortunately, we weren't shareholders of Gold Road either, because this was been baked in. There was a first offer last year or earlier this year.
No, a couple of weeks ago. It was pretty quick.
Okay,
so
yeah, unfortunately we weren't shareholders of Gold Road. So that's Goldfields. The other big thing, and this is something I haven't seen in a very long time, was a plus 9-digit financing for an exploration company. This is shades of 2010. If you want to go back that far, pre-resource exploration company, and so obviously we're talking about the 120 plus $1 million financing for Southern Cross Consolidated, which is a financing we saw coming. So, and for those of you, just to catch you up a little bit on the history, for those who don't remember, the asset that Southern Cross has, Sunday Creek in Victoria in Australia, was originally held by a company called Mawson Gold. Mawson spun that asset into a company called Southern Cross that was listed in Australia. Mawson was listed in Canada, and also had assets in Finland. Mawson spun out its Finnish assets, now called Mawson Finland, and then through an amalgamation remerged what was left of Mawson, which basically really the asset was owned 50% ownership of Southern Cross, back together and became Southern Cross Consolidated. Long roundabout way to undo what had been done not that long ago. But the reason for it is that Sunday Creek has become a spectacular asset. It is probably one of the better, obviously based on its valuation, one of the best exploration assets out there. Have really good drill results, good drill success. They sort of unlocked the mineralization, and it has exploration upside sort of in the core, and it has exploration upside along strike and on other places on the property. And of course, it's in Victoria, the same area. Probably a little bit of romance for investors, but it's the same area as Fosterville, which is obviously transformed Kirkland Lake with that the high grade with its high grade discovery. And so it's a very interesting thing. But I think I don't know. There's two things to talk about here. One, the market impact of a financing like that and what that kind of means, and the second is maybe Southern Cross and what we think of it and where it sits. So maybe, Sam, 9-digit financings for pre-resource exploration companies are pretty rare. Maybe give us when you see something like that, what does that tell you?
Well, first of all, tip the hat to Mike Hudson and Nick Mead, with people we know very well. Very, very great people in our space. And it's quite impressive that they're able to raise that kind of money, because when you think about, we were looking at takeovers just last year and the previous years in that quantum, and now you have pockets of investors willing to pony up all the capital at once. Like you said, for a pre-resource company, it's a special company. Obviously, it's like all the merits you just brought up. The exploration is by no measure done. Actually, what this tells you is that there's going to be a very aggressive exploration expenditure over the next 24 months to try to really figure out how big this could be. I don't think I can add much more than it's just a fantastic sign of new capital coming into the market. The existing capital can't recycle quickly enough on a financing like this, on the announcement, to come up with 150 million or 140 Canadian. I forget the exact number, but it's around those numbers. So this would have gone necessarily to the US and to more diversified funds. And I think that's excellent news that we have that kind of money coming into the market right now.
Yeah, I think that's the thing, right? I think we said that I've said this before, but when you get to 9-digit financing, $100 million plus, very, very unlikely that it comes from traditional sources. Those are very often, as you said, new money coming in. And so I think that's an important thing. And I, starting to talk about Southern, shifting that and saying, okay, well, why are people so excited about Southern Cross? Well, I mean, I think the key thing here is, and I think it's important, is that, sometimes, and we've seen this with other exploration companies, when you get a highly valued exploration stage company pre-resource, now they have an exploration target out, which points to a pretty sizable resource. And knowing Mike as well as I do, I would be surprised if he didn't think he could back it up. But I think, one of the things that happens with these highly valued exploration companies, especially ones that have, high grade nuggety gold, which we've seen here, highlight a Newfound Gold or an Amex, is that it costs a lot of money to get to the resource, right? To actually deliver the resource that your stock is pricing in. And just for the record, based on the exploration target, Southern Cross is trading, roughly $400 an ounce. And you mentioned earlier, that, recent takeouts. So the natural comp to this, it's about the same size, a little bit smaller, or a little bit bigger, sorry. But similar grade in a similar jurisdiction was Cisco when they got taken out by Goldfields, and they were a joint venture partner. Now, we already discussed that we think Goldfields bids expensively, but they paid about $430 US an ounce for the part of the project they didn't know. So this is, from a valuation perspective, it's relatively high. Now, we all know not all ounces are created equal, but these are very similar ounces, similar jurisdictions, similar grade. Now, what I would say is that, Cisco probably drilled off Windfall. There's 1.8 million meters went into Windfall plus. So, there probably wasn't, maybe there's more there, but not tons more in the core resource area, where I think that's what the big difference is here to Southern Cross. Where I was going with this, the fact that they raised $140 million or $130 million is that they have the runway to drill this thing off. I think that's the key point. They have test the upside targets and drill the spacing down as tight as they need to. And they don't have to come back to the market in the interim. They're not living and dying by every drill result and having to raise that money. They put a pin in it. They can go and do their work to prove the resource that they have here.
One thing that I want to give them credit for is about 2 years ago, they started talking about how to fix the Southern Cross and Mawson sort of like 50-50 complexities. But there was a plan to the plan changed as it should when new information becomes available. It had to do with taxes in Australia and things like that. But the plan was always to put this whole thing together and convince investors that giving them a substantial amount of money to prove the resource was worth it. And I think at the time we were speculating, this didn't come from the company, that they were looking to do maybe a $50 million raise or 50 million US, which at the time sounded insane. And here we are less than 2 years later, and they've executed on this plan. And I think it's commendable when people are able to articulate a plan and then deliver on it. So in this case, I think they deserve the recognition for that. It sort of came up exactly as they thought it would.
Yeah, it took them a long time and a lot of effort to get to here. And they've had backers to support it, and they had to be probably a little more prudent with their capital than they wanted to be to get through all of that. And that was I guess full disclosure, we owned Mawson pre the merger. I think we did reasonably well on that position. You said you were saying, Sam?
I said we did exceptionally well.
Yeah, I think we made 100% on that position. Kind of looking ahead to seeing that we thought that our thesis was this financing was coming. We had materially reduced our exposure. We'd sold the position. And now, obviously a big financing is coming. So you see something like this and you reevaluate, right? What's out there. And so, that's something that we're doing right now. But, there are lots of things to like about this name, right? The exploration upside, which we talked about, it's very high grade, talking about 8 to 9 grams a ton equivalent, has antimony, which is not a buzzword from a critical minerals point of view. You need antimony to make bullets. I can tell you right now, antimony is important. Um, they've got tons of money. It's in a very good jurisdiction. Um, it's not Western Australia, but it's still Australia. They know what mining is. There are active mines in that region. So I think these are all things that are going for it. And I think, something we have to revisit internally to decide what we're going to do. We didn't participate in financing either.
But one thing that I still can't shake is that things seem to me moving a lot quicker in Australia than they are in Canada, and that's sort of to our detriment. We had the $5 billion De Grey takeover. We're having this $2.4 billion Gold Roads takeover, the Westgold Karora merger, the Ramilius and Spartan. Then you have this project that's able to raise 140 million. It's like, Northern Star, Evolution, all-time highs. I'm not saying we're not participating here in Canada, but it does feel like there's a lot more energy in the Australian market for these gold equities, and I just hope that it kind of, we get more of that here in Toronto and in Canada with our names.
Yeah, I think that I think that's a great point. But historically, and historically, maybe the last 10 years or so, and because Australia seems to have led on these things. They seem faster to pivot towards commodities, whether it's rare earths or iron ore, or and it actually doesn't matter the commodity in Australia. If you can mine it, and they think it's an investable thesis, there's money behind it. But I think they tend to lead. Historically, the Aussie markets have led from that perspective, in the sense that they move first. So hopefully that's a sign of things to come. But yeah, you're right. I mean, we've seen a lot more developers taken out in Australia than we have in Canada at this point for Canadian markets. So might say something about permitting in Western Australia. Probably says something about Australian capital markets and the differences between here and there. So yeah, I mean, I think those are all valid things. So yeah, I mean, we're always looking at Aussie. I mean, we have a global mandate, so we're always looking at Aussie investments, and generally what shies us away is that they tend to be a little bit more expensive than their North American peers. But one thing we've learned, and this is something it could be said about Southern Cross, it's something that could be said about a lot of Agnico and other things, is that just because something is expensive doesn't mean it isn't going to go up. And generally, companies have earned those premium multiples. And I think Southern Cross is a perfect example of that. Southern Cross is a company that's earned this premium multiple. And so it does have, there is room to the upside there. But, how much is always a question. But I think this is something that, I think it's a mistake that investors often make. And sometimes we make it too, right? Is that we look at something and go, hey, that looks expensive relative to its peers. But I think you always have to go back and look at, why is it expensive, and what am I getting on a relative basis because it is expensive. And what happens is in these cycle changes and is that's where the money gravitates first. The companies that are expensive for a reason, if I was sitting in a generalist hedge fund and I had the mandate to increase my gold exposure in New York, and I'm not allowed to buy the ETF. What am I going to buy? I'm going to buy Agnico Eagle, or I'm going to buy Franco-Nevada, which are in both cases on a relative multiple basis way overvalued relative to their peer groups if you just looked at multiples. But there's a reason for that.
A good point to end this episode.
So still very interesting things in the market generally. We'll see what I think there's not much moving on the macro front. The market's digested the tariffs, so we're happy with where we are. But there's always opportunities that we're looking at. So look forward to speaking with you guys again next week.